Welcome everybody. Thank you for turning out. I didn't think I'd ever be stood at the front of a budget seminar and apologising for repeatedly using the C word. Just in terms of a bit of housekeeping to start us off, there aren't any fire alarms planned for today, so if you do hear an alarm then please run.
Oh, just to add to that, if there's any Archers fans in, we're not expecting the conference centre to explode in a fiery ball of destruction, so again, if it does, run screaming for the building, I suggest.
On the tables there are a limited number of paper surveys which we would ask people to complete. If there aren't quite enough, then our marketing team will be emailing those round to you after the event, and it'd be great to hear your feedback. There's also newsletters which you're more than welcome to take with you, and if you don't currently receive them and would like to, please just let either myself or one of the team know. And then finally, just because we are joining the modern world, kicking and screaming, our jelly bean pots, if you take them with you, are compostable. So yeah, please do with those as you see fit. So kicking off the budget of yesterday, we thought we'd just sort of give a general feel as to what sort of a budget it was for people, what we'd heard, what the feedback was that we'd had. I think in the main, most people felt, yeah, it was okay. It was quite a sizable shift in policy. Clearly we're going much more for a borrowing route rather than using tax increases to fund the huge amounts of public spending that were included in the budget. And I think listening to somebody last night on the way home, they were saying that ultimately in times of crisis what we look for is for the government to be a bottom line sort of safety blanket. And I think this budget really just reinforced that. It's very much trying to steady the ship. There's nothing too groundbreaking. There actually, much to Owen and I's disappointment, there's not very much tax in the budget this year. It was much more focused on public spending. But we will try and take you through it. So, what were we expecting? There's been an awful lot in the press over the last month or so. Owen and I this year tried to prepare in advance, and we even got the Chancellor wrong. Where we did end up, it felt very much that this was, there was a lot of talk. I'm not sure who drives this, but entrepreneurs relief, there was an expectation that that might have been completely abolished. It has been curtailed, which Owen will explain in a minute. We've heard every year for the past 2 or 3 years that they've been looking to remove pension relief for higher rate earners. But again, we didn't see that. So they were the two key things that I was expecting to see in the budget. And I think Owen had a couple of points as well.
Yes, there have been a number of reports to the government circulating which suggested that we might get very significant inheritance tax changes. Coupled with that, and actually part of almost the other side of the card from that, there was talk about changes in the tax treatment of trusts. Nothing on either of those fronts happened, I'm glad to say. So in terms of inheritance tax, business property relief and agricultural property relief stay with us for now. That's no guarantee they're always going to be there. So if you do think you've got a significant inheritance tax exposure, it'd probably be a good time to speak to people to see if there's any planning you need to do sooner rather than later in case of any of these changes do come through in subsequent budgets. Also, trusts are quite useful tax planning vehicles, but they also serve very good family planning vehicles in terms of protection of assets, etc. There was talk of bringing in immediate lifetime charge on any transfer into a trust. So if you've got assets that you want to pass on to the next generation, but retain control of them, so they're outside your estate for IHT, but you've still got some control over them being frittered away, again, it might be a good time to have a look at those. So again, maybe have a chat with us. And then finally, there's national insurance changes, which I've completely forgotten what they.
There again, it was just we've been talking about for years, creating some parity between self-employed and employed workers, and they were also talking about increasing the national insurance thresholds to be in line with the personal allowance. They didn't quite get that far, but they have increased it. So what did we actually get? We got Rishi Sunak, the new Chancellor, who delivered his budget, and it was very much it felt like the end of austerity, and as I say, a change from the last 10 years. I've put there a money tree. I actually heard somebody say last night that it wasn't so much a money tree as a money forest, and there was a member of Parliament who said that they thought it might be physically difficult to spend as much as he'd promised within the 5-year period. I did message him my wife's phone number very quickly because she can spend if there's money there. The headlines that came out of the budget really, and these will probably be the ones you've seen on the news this morning or last night, the change to the entrepreneurs relief, as I say, Owen's going to cover in more detail. R&D tax credits, that's not quite as useful as it first sounded. The employment allowance increase, I did have a little smile when I saw that one come through, because I'd taken several calls this week where clients had received letters about the employment allowance reforms, which meant they were actually going to be able to claim less, and now the government have increased it. Business rates relief we'll cover in a bit more detail, because I think, as Jonathan was saying, over the coming years or months we could be in for some very tough trading times and trading conditions, and I think that could be a real lifeline to a lot of small businesses. A couple of VAT changes, abolishment of the tampon tax and changes to VAT on e-books, the national insurance increase, and then really it was the public spending on infrastructure, mobile, rail, road networks, and the coronavirus provisions. Digging through the budget, as I said earlier, there wasn't a huge amount in there from a tax perspective, but the things we did pull out, there's been a change to the pensions annual allowance, which we'll do our best to explain. There's been a tweak to the structures and buildings allowance, a very techie point on top slicing relief provisions, which we won't spend too long boring you with, and then following on from, again, Jonathan's comment, the time to pay provisions that have been introduced. That's really HMRC trying to help taxpayers who may have HMRC liabilities, be it PAYE, personal or sort of income tax, corporation tax, agree timelines to pay those to manage the cash flow. And then there were the usual bits that we always get in a budget, so confirmation of the rates and allowances for the forthcoming year, and confirmation of announcements that have come out throughout the last 12 months. So I think with that, Owen's going to give you an overview of the entrepreneurs relief changes.
Thanks, Ian. Yeah. So entrepreneurs relief, it was very widely rumoured before the budget that this was going to be scrapped entirely. There was criticism of it from many quarters. Certainly the Labour Party were very critical of it, seeing it as a rich person's tax break. Many of the professional bodies as well said it was, they believed it to be over generous. There's maybe some truth in that, but to give you a quick recap on it, what it was is if you have owned a business for more than 2 years or own shares in a trading company for more than 2 years, and then you dispose of that business or your shares in the trading company, you get a 10% tax rate as opposed to a 20% tax rate. As I say, it was rumoured that it was going to be completely abolished, but what they've done is they've reduced the lifetime limit from £10 million down to £1 million, which on balance is proportionate, I think, and I know some people I know are going to be a bit cheesed off about it. However, I think it still gives a degree of relief to people in the context of family-owned businesses. To put it in historical context, it was introduced because it was recognised that very often people running their own businesses maybe don't make sufficient provision for their pension because they're ploughing their money and their efforts back into growing the business. So therefore there used to be something called retirement relief, which was scrapped and then replaced a couple of years later with entrepreneurs relief, which, as I say, stood in its shoes to an extent. So instead of being able to build up one business, sell it for £5 million, enjoy a 10% tax rate, then grow another business, sell it for £5 million and enjoy 10% tax rate, I'm only ever in my whole lifetime now going to get the first £1 million at 10%. That's effective from yesterday, with some forestalling provisions and some transitional provisions, such that if you've got sufficient evidence that a binding contract was entered into before yesterday, you should still be able to get your entrepreneurs relief. But I think they're going to be fairly critical when examining those. And 83% of entrepreneurs are going to be unaffected, and as I say, we tend to see this in the context of exits from owner-managed businesses, and very often the £1 million is going to be enough to cover those.
I think from just adding on to that, from my perspective, I act for quite a lot of farmers and landowners, and it's been quite common with the amount of development land that's been earmarked, certainly in and around Oxford, and I'm sure it's the same down here, that as soon as some land gets earmarked in the local plan for development, you would be saying, let's farm that land for a couple of years, and then when you sell it, we'll cease the business and you should be able to claim the entrepreneurs relief. Because this allowance wasn't based on the business, it was each individual. If you were to have, let's say, two brothers and their respective spouses, there's the potential there that you had a £40 million allowance on the sale of that land, and that's effectively dropped to £4 million. So I think in the immediate term, it might actually be land sold for development purposes that gets caught by this in the first instance.
Then the next change we were going to cover is corporation tax R&D allowances. This was a very minor change. It's only it's changed to the rate of the increased tax credit you get on the RDEC claims, which are principally larger companies, which is an above the line adjustment which gives a tax credit which you're also taxed on, and the RDEC relief is also in certain circumstances available to smaller companies. However, it gave us an excuse to shoehorn in a reminder about the SME scheme for small and medium-sized enterprises, which is a very useful relief, and a relief which HMRC's own figures suggest is underused and underclaimed. With SMEs, the way the relief works is different to the RDEC system. You get 130% relief on qualifying expenditure, so that if you've spent £1 million on a particular R&D project, for tax purposes you get a deduction of £1.3 million. And then if that tips you over into making a loss, which in the early years of very research-heavy projects where you're looking to bring a particular product to market is quite common, that loss can be surrendered back to HMRC for a 14.5% repayable tax credit, which is, as you can imagine, incredibly useful if you start a business and you're in that money-burning early stage of it. And again, just a reminder, it's not just for white coat industries where you've got people swirling chemicals around in tubes. The legislation, the wording of the guidance is quite broad, and it does include various definitions along the lines of the application of an existing technology in a new way to provide some gain in terms of efficiency or productivity. So we've certainly made successful claims in the context of what I would call metal bashing construction and manufacturing companies. So I don't think it's exclusively reserved for the boys in the white coats.
So the national insurance changes, these were really the if you like, the flagship tax saving for the masses that came out of the budget, because as I'll come on to later on, they've actually frozen the personal allowance this year. What they have done is increase the rate at which national insurance becomes payable from 8,632 up to 9,500, which means that obviously there's a higher threshold before either whether you're employed or self-employed before you start paying your Class 1 or Class 4 national insurance. The bottom point there, the employment allowance. So again, this is very widely used. It means that businesses that employ or have a number of employees and have a national insurance bill of up to can claim £3,000 against their national insurance cost per annum. They're increasing that by £1,000 to £4,000. The point of this really was to help the very smallest businesses and to drive an incentive for them to employ people. So I think it's continuing that drive to keep employment low, and is really designed to further help very small businesses. The vast majority of larger businesses, and you see there are thresholds applicable. £1,000 isn't going to make a huge difference to that.
Right, the next area we come on to is pensions, and in particular the annual allowance. Just to jump back to one of Ian's earlier slides though, in the general context of pensions, again it was completely widespread concerns before the budget that they would reduce the higher rates tax relief on pensions from 40% to 20%. I'm delighted that they didn't, because as I say most years, us taxmen get so excited about pensions because it's one of the most tax efficient ways of spending your money really. If you've got your own company and you can get it to buy your trading premises, you can get a corporation tax deduction for your pension contributions. Your pension scheme doesn't pay tax on those rent payments. Sorry, and the pension scheme buys your trading premises and rents it back. The rent that you pay, you can get a corporation tax deduction for. Pension scheme doesn't pay tax on the rents it's receiving, and the rise in the property value within the pension scheme isn't taxed again because they're exempt from capital gains tax. So great news, and if you're not maximising your pensions scheme, well, we've still got it. You should be. Anyway, turning to the actual thing I'm supposed to be talking about, pensions annual allowance. This was introduced a few years ago, where the maximum pension contribution for which you could get relief was dropped to £40,000, which again in turn is further reduced if you've got income, two different tests of income over certain levels. So if your threshold income was more than £110,000 and your adjusted income was more than £150,000, there was a potential for that £40,000 to be reduced down to a maximum of £10,000. Broadly, the threshold income is your income reduced by certain amounts, and the adjusted income is broadly your income plus pension contributions. So there were two tricky tests that we had to look at every time, and with it, if you failed those, rather than getting tax relief on your 40,000, that could be reduced down to 10,000, and any excess you could cop a tax charge on. This was causing a lot of our senior doctors and surgeons, etc., huge headaches, and I've also seen it in the context of very senior management team people from education and GPs, etc. This was getting to the extent whereby registrars and surgeons in hospitals who were required to do overtime to cover staff shortages, actually was ending up costing them money to go to work because of the extent of the excess pension charges they were getting. So to recognise this, and I think it will be very welcome in those particular sectors, they've increased both the threshold income and the adjusted income limits by £90,000 to take the threshold income up to £200,000 and the adjusted income up to £240,000. So that's very welcome. However, they've also reduced the bottom figure that I mentioned of 10,000. That potentially goes all the way down now to £4,000. So if you're a very high earner, or you know very high earners who've got pension schemes, they do need to look at that very carefully, because that's really a tiny allowance now.
And it's no coincidence that the industries that Owen's mentioned there, the education sector, the NHS, GP surgeries, etc., this really impacts people who have still got the defined benefits, so final salary pension schemes, because they have much less control over the deemed contributions in a given year, because it depends on the hours, etc., that they work and what their final pension looks like it's going to come out at. So they're the people who typically were being most affected by this, and with any luck it should help them. But it's worth noting that this only comes in from April this year, so actually for the current tax year that we're in, that finishes on the 5th of April, they may well still have pensions charges to deal with. So the coronavirus support, this was, unsurprisingly, this rather took over the budget this year. The government had announced, I think on Monday, certainly at the start of the week or before the budget, that statutory sick pay would be payable from day one for any employees who self-isolate. What we've actually got from the budget is a bit more of the detail behind that. So it also covers people caring for those that are in self-isolation, so it's a slightly wider remit than I'd perhaps first realised. But if an employee doesn't have a contract of employment, which I appreciate is very rare, or they're on 0 hours contracts, then they are not covered. So just a point to note there, really. What I would add from this is the government have been a little bit woolly in how they're going to repay these amounts. They've said that for up to 14 days they'll reimburse the business who's paid the statutory sick pay, but they haven't really given the timescales on that yet. And I think for this to be of real benefit, it needs to be quite a quick turnaround to help manage the cash flow situation for the businesses that are having to pay this but not having the staff to generate the sales or the income that would normally be coming in. They also it was being called for, but they've also offered support for self-employed individuals by way of removing the income floor for people to claim the universal credit, and saying that will be available much quicker, and also being able to claim the employment support allowance from day one of not being able to work, as opposed to the current level, which is day 8. So again, whilst neither of these measures will reimburse employees or self-employed individuals for their usual levels of earnings, it's certainly a welcome step and should help businesses cope with what we face over the coming weeks. So I'm now going to take you through the usual sort of personal tax and savings, and I'll start off with top slicing relief changes. Sadly, it has absolutely nothing to do with a neatly carved up brownie. It's a very, very techie point, one that excites Owen and I, but probably won't do a lot for the people in the room. If you've had chargeable event gains over the last couple of years, you may well have either been aware of or had conversations with your advisors that HMRC's calculation didn't appear to be correct. They were removing the personal savings allowance and therefore overtaxing a lot of people who had significant chargeable event gains. HMRC have recently lost a tribunal case, which is what's driven this, and have given in, and they've said they're going to change their calculator, but only from April. So if you have chargeable event gains in the current tax year or last couple of tax years, it would be worth having a chat with us or with your advisors, just to make sure that your calculation's been correct, because as I say, HMRC themselves actually aren't getting this right all of the time. The personal allowances, this was really notable by its absence, and I was shocked by this, and I'm probably going to depress some of you in the room, but this was the first time in my working life that the personal allowance hasn't increased, and I had to look back and see when the last time the freeze was, and it was just over 10 years ago. However, to put it into context, the last time this was frozen, it was frozen at £6,405 in the year 2010-11. So there have been some significant increases over the last 10-year period, and I think this is probably a sign that the Conservatives, they've met their manifesto promise. They've got the higher rate of tax to £50,000, and I suspect we may well see this frozen for some time. On the plus side, it does make our job easier because it's one less allowance to update. Come on. Personal savings allowances, whistle-stop tour, you can earn up to £1,000 of bank interest or £500 if you're a higher rate taxpayer before you pay any tax on it. Those rates and allowances are unchanged. Again, starting rate for savings, if you only have fairly modest levels of income that's non-savings, so typically we see it with older people with pensions, you can actually earn up to £5,000 of interest before starting to be taxed on it. They kept the basic rate at 20%, and as I say, up to £50,000 worth of earnings. I think this may well now be frozen for some time. It's clear that they weren't going to give away more than they had to in this budget, and these were things that really sort of slipped under the radar, I think. Dividend tax. I've left this in there. As it says, there's no changes, but I'm conscious that there are going to be a lot of small business owners in the room, or business owners in the room, who have felt the impact of the dividend tax changes over the last 6 or 7 years. Back in 2015, somebody who owned a business could take out effectively £40,000 without actually paying any further tax on it because there was a deemed tax credit. That got removed in 2016 and replaced with a £5,000 allowance, and then following that, the next year it got dropped to £2,000. There have been calls for this to be scrapped altogether and all dividends to be taxed. We were all quite pleased, I think, that they've left this well alone. So the way that it works now, you can earn £2,000 of dividends, or take £2,000 of dividends tax-free, and then above that, in your basic rate band, it's 7.5%, higher rate 32.5%, and then if it's above 150,000, it goes up to 38.1%. I would say particularly the 7.5% rate, if you're able to structure a business well with perhaps a spouse, there is still scope for a family to take a reasonable level of income at 7.5% tax, which actually, compared to historic tax rates, is still very good. Again, I'm just really reiterating bits and pieces that have come out over the last couple of years here. The marriage allowance is still in place. Because the personal allowance was frozen, it's remained at 10%, so £1,250. It applies where you've got a married couple or civil partnership, and one is a basic rate taxpayer and one doesn't pay any tax at all. The person who doesn't pay any tax can transfer up to 10% of their personal allowance to their spouse, which, as I say, at the moment can save up to £250. I think the win here is that you can backdate claims to the 15-16 tax year. It's very straightforward to do, and it could mean that you get back sort of just over £1,000 in tax, which is clearly worth having. Skip over this side. They haven't changed the rates at all, so they are still as they are, or as they were. You still lose your personal allowance if your income exceeds £100,000. It gets removed at a rate of £1 for every £2 you're over, so it's completely eliminated by the time your income is above 125,000. I would just say, as I always do, that if your income is in that band between 100,000 and 125, please do seek some advice. It's an effective 60% tax rate, and there are planning measures that you can take to avoid it. This one was the one that scared me, if I'm honest. So the usual ISA has been retained at £20,000. Very useful we're still seeing people undertaking an awful lot of bed and breakfasting, so they'll sell shares that aren't in an ISA wrapper and repurchase them each year within that to try and build up a significant ISA portfolio. The one that got me here was the junior ISA and the child trust funds have both seen very large increases in the annual amount that you can save. They've jumped from £4,260 per annum to £9,000. I always say the same thing. In principle, it's a great idea. With the junior ISA, if you save the maximum amount each year from when they're born until they're 18, you would have, with some reasonable returns, just over £200,000. You do have to sign this account over to them when they turn 18. If I'd been given £200,000 at 18, I'm not sure I'd have used it in the wisest way. So just be careful with that one. Whilst it sounds very attractive, there is a sort of serious point that you just need to protect children, particularly if they're at an age of going to university, etc. So I think now Owen's going to talk you through the corporation and business tax changes.
Yep, not a huge amount to report here, but we'll have a quick counter through them. So the first change that we saw, and we knew this was coming, is it was proposed that the main rate of corporation tax, well, the only rate of corporation tax now, would be decreased to 17% with effect from 1st of April this year. That's been scrapped, so the rate stays at 19%. Well, I suppose all we can really say is that at least at this point it hasn't increased, because it's still relatively quite a low rate of corporation tax. Capital allowances, there's been some clarification and some forward-looking on the annual investment allowance. The normal way capital allowances work, forgive me if you're familiar with this, is if I buy a big piece of plant or kit that I use in my business, I can't write it straight off against my tax in year one. If it's normal machinery, I get a writing down allowance at 18%, and if it's special rate pool, which is long life assets and assets that are integral to a building, so for example lighting and that kind of thing, the special rate pool only gets a writing down allowance of 8% per annum, which is going down to 6%. So as you can see, it took you a very long time to get your tax relief under those circumstances. However, we've had introduced temporarily an annual investment allowance, which means that expenditure on plant and machinery of up to at the moment of up to £1 million can all be written off in year one without having to worry about these relatively small writing down allowance. That £1 million has been continued through until 31st December 2020, but then thereafter it will revert to £200,000. So I think the first point is if you're involved in a business that's spending an awful lot on kit, or you're having a new building put up which is going to have a lot of integral features in it, it's worth identifying especially the integral features as the first protocol to put into your annual investment allowance claim. The second point worthy of note is if you've got a year end which is beyond 31st of December 2020, typically we have a lot of 31st March year end, so if you've got 31st March 2021 year end, watch the timing on any big plant and machinery fixtures and fittings purchases you make, because you might expect, if you purchase it after 31st December, to get a proportion of your £1 million, so 3/12 of your £1 million. You don't, in actual fact, you get a 3/12 of your £200,000 because of the way the legislation works. So you could find yourself expecting to get a big deduction for your big piece of kit purchase and not actually getting it. So come and talk to us if you're thinking about making any large purchases. The other thing to watch out for if you're making purchases on hire purchase contracts is to make sure you comply with the rules, which are that the assets must be on site and in use by the year end to get the allowance, or the relevant date if you're looking at annual investment allowance on 31st of December. Now, we've seen this challenge recently. I think Ian's come across it particularly with farmers spending a lot of money on big combine harvesters. So they bought the combine harvester with the expectation that they're going to get full capital allowances on it. They bought it at the end of December. HMRC turns up to have a look and says, that's fine, it's on site, yeah, you've complied with the first leg of the HP requirement, but it's not in use in the business yet because you're not going to harvest anything till August, so no, you can't have your annual investment allowance on it or any capital allowances on it. So just be a little bit careful with that one. Structures and buildings allowance. I found it quite difficult to get excited about this when it's introduced. I've got ever so slightly more, less disinterested, I think would be the correct expression to use. So historically we used to have industrial buildings allowance and agricultural buildings allowance, which gave you a tax deduction on the construction of a new business used in agriculture or industrial production. That was scrapped 15 years ago probably. In the period since then we've had no tax relief whatsoever at the time of building on any properties. So last budget I think it was, they introduced, with the hope of encouraging people to start chucking up buildings over the place, they introduced a structures and buildings allowance, which initially had a 2% per annum allowance on them, on qualifying expenditure on new non-residential buildings, which was to be introduced for projects commenced after the 29th of October 2018. Just on the construction costs, not on the costs of the land or dwellings. So I suppose 2 points from this. Firstly, I'm not terribly excited about it as a relief, because if you spend £2 million putting up a qualifying building, you're going to get a 3% annual allowance on that, which is 60,000, and with a corporation tax rate of 19%, that's actually going to give you a deduction in terms of tax relief each year of 11,400. So I don't think £11,400 tax relief is going to spur many people in terms of making the decision to undertake a project, a £2 million construction project. The second point, going back to our previous slide, is obviously if you can speak to your architect and your builder during the process of putting up a new building, rather than getting a rather unexciting 3%, as I just outlined, if you can get them to detail all the stuff which isn't actually part of the building, which counts as integral features, so all of your lighting, all of the heating, etc., any computer infrastructure that's built into the building, we can separate those out, we can put them all into the annual investment allowance claim, and we can claim a write-off in year one against tax rather than having 3% a year for ad infinitum. Excuse me, I'll just mention this one very quickly in passing. I think this is one designed to please the masses and the popular press. There's been a lot of talk over recent years about how dissatisfied people are with the fact that Amazon and eBay and the like aren't paying their tax in the UK. There is supposed to be an international review of this with the OECD and various other interested bodies, but we, as our Chancellor, Osborne as he was, has decided we're not going to wait for that, and the current Chancellor has agreed he's not going to wait for it. So they're bringing in a form of taxation on these huge multinationals from April this year. So they're going to be charged 2% tax on revenues derived from UK users, and those are users of search engines, social media, platforms and online marketplaces. There's a £25 million per annum allowance, so they won't start paying it until their profits exceed that, and it only applies where they have global revenues in excess of 500 million. not going to be of direct relevance to anyone here. However, I thought it worth mentioning in passing. The final one is a bit of a techie one. A couple of years ago, well, 2017 now, we had a relaxation in how corporate losses could be used. So brought forward corporate trading losses can now be set sideways against total income. The payback for that was a restriction was put on that to 50% of the losses being capable of being used if certain limits were met. They've now mirrored that in the capital gains tax legislation. So if there's a large capital loss brought forward, that only half of that can be used against capital gains in subsequent accounting periods ending after 1st of April this year, where a company's gross profits exceed 5 million. So again, likely to be limited in people it impacts, but just worth mentioning just in case.
Thanks, Owen. So we're now going to move on to the capital gains tax and the inheritance tax. These actually largely weren't in yesterday's budget at all, but are some of the most important things to be aware of. So starting off with changes to the payment dates for capital gains tax if you dispose of UK land or property. We've all got used to the fact that you can dispose of buy-to-let property, some land, etc. Let's say you dispose of it just after the start of a tax year, and you've then effectively got 21 months before you have to report it and pay any tax that's due. From April this year, that will change in line with the same rules that have been enforced for non-residents for a couple of years, and you will now need to calculate, the best estimates are acceptable, declare and pay the tax within 30 days of the sale of the land or property. I think there's a few points here really. The first is one, if you've made a loss on the property, there's no tax payable, or it's completely covered by principal residence relief, it's always been your main home and you're just moving main home, you don't have anything to report. You wouldn't need to report under the current rules, and you don't have to report under these. I would then say it's about planning and preparation. You need to, because you've only got a 30-day window, you need to make sure that if you're likely to be caught by this, one, you speak to an accountant or register for a tax reference number yourself if you haven't completed a tax return previously, because HMRC can be slower than you might expect in issuing those. I think you need to have the conversation with the conveyancing solicitor as to whose responsibility it's going to be to actually complete this. I can see this falling between the two gaps, to be honest, or falling down the gap between the two of us, to be honest, because how often do I speak to a client and they say, oh yeah, I sold a property 10 months ago. Well, that's not good enough anymore, because you'll be hit with penalties and interest for not reporting within the 30 days. So I don't think the conveyancing solicitors will want to take this on, because it is very much a tax point, but just make sure that there's conversations happening there. So yeah, as I say, it's making sure you're clear on whose the responsibility is and that the paperwork's prepared or dug out in advance.
Right, so quick scamper through private residence relief, which is a generous relief. Historically it's been a generous relief, a sensible relief, because if I live in a house for 30 years and then sell it, the likelihood is I'm going to have to buy a replacement property. So if I parted with a load of tax on the capital gains I'd made, I might find myself unable to buy a replacement property. So historically, the gain that you've made on only your main residence is completely exempt from capital gains tax. If it hasn't been your main residence for the whole period of ownership, it's prorated, and it's prorated very broadly on the basis that if I've had a property for 20 years, I've lived in it for 10 and I've rented it out for 10, very simply half of the gain's going to be exempt and half of the gain's going to be chargeable. There are, however, a number of reliefs which can stand to reduce that. The first of those is that there's a final period exemption which means in effect that we pretend that you're still living in the property for the last 18 months at the moment of your ownership, so long as at some point it's been main residence. That was originally 36 months, it's been reduced to 18 months, and it's now being reduced to 9 months. There was a perception that it was being abused. It was being abused quite a bit, but mainly by MPs who were flipping properties and making elections as to which one was their main residence, so they got the last 36 months as it was. But they're taking it out on the rest of us now, so we're all getting a reduction to 9 months. There's also a letting relief currently until 5th of April this year, where if at some point it's been your main residence and then you've let it out, you get another deduction which is equal to, bear with me on this, it's quite difficult to explain, it's equal to the proportion of the gain that's exempt because it was your private residence, or £40,000, whichever's the smaller. And that was £40,000 per person, so if we're talking about a married couple, that's a potential of another £80,000 which could be exempt on a property that you may have let for some time. That's effectively being abolished because they're saying you can only get it if you're sharing occupancy with your tenant. Well, we always considered that was already exempt because you'd probably be getting renter room relief, which means the gain wouldn't have been chargeable. So effectively that 80,000 up to £80,000 additional relief is in effect being scrapped. I think it's worth noting that it's still generous. There's still a lot of things you can do. So if you've got 2 properties which you occupy, so a holiday cottage and a house you live in the week, you can elect which one's going to be a PPR. So typically what we tend to do for clients is we elect the holiday cottage as the main residence for a couple of weeks and then elect it back to the week time residence. And that means at least when you sell your holiday cottage, because it's been your PPR for a scintilla in time, those 2 weeks, you at least get the 18 months at the moment, or going down to 9 months worth of PPR relief. Every little helps. There are also reliefs covering periods of absence because you're in job-related accommodation, period of absence because you're working abroad, or periods of absence for up to 3 years for any other reason. So if you're selling a property or planning to sell a property which has been your private residence at some point in the past, probably worth having a chat to us just to see if there's anything you can do to maximise the still relatively generous reliefs that are knocking around.
Starting takes on to the capital gains tax allowances and rates. Whilst the personal allowance for income tax purposes was frozen, the capital gains tax rate was increased from £12,000 to £12,300 for next year. Trusts get a 50% allowance of that, so theirs is £6,150. They've kept the capital gains tax rates at 10 and 20% for the majority of assets. It's just residential property that carries the higher rates of either 18 or 28%. I think just one thing I would add on that, clearly everybody has a capital gains tax threshold, but if you are caught by this 30-day reporting on property disposals that's coming in, you actually do far better to ignore the fact that you've got that allowance there. HMRC have said that if you then subsequently, so you have to calculate tax as it is at the time. If you then subsequently sell another asset that would use that allowance, then they will assess back for interest on any underpaid tax at that point. And similarly, if you subsequently in the tax year sell something for a loss, whilst you might think, oh, I can just notify them and get some of my capital gains tax that I've already paid back, unfortunately that's not the case either. You have to wait until you do your tax return in the following year. So it's about taking really the worst case scenario but making sure you get it as accurate as you can. This next one was really the one that I was most pleased about. There was very little mention at all and no significant changes to inheritance tax announced in yesterday's budget, there was, going back 6 weeks or so, there was an all-party parliamentary group report on inheritance tax, which actually suggested some quite wide-scale reforms. The two biggest points was that it was suggesting that the two key reliefs at the moment, agricultural property relief and business property relief, should both be abolished entirely. It was also talking about changing the rate of inheritance tax and changing the rules on annual gifts. To try and it's all been driven by the Office of Tax Simplification trying to simplify inheritance tax. That's what's driven this report, but it seems to have been taken over by the fact that there's a public perception that the APR and BPR reliefs are only really utilised by the very wealthy, meaning that they pay less inheritance tax than someone who's just over the threshold. I think, as I say, there have been no changes at the moment. I think that's probably reflective of the sort of steady the ship budget that it was. But you do need to be aware that these are going around in the background, and that we might see more news on this over the coming months when you're looking at your current planning. So it's really just a watch this space.
VAT, right. Welcome news that there wasn't a great deal on VAT either. There's no change on the registration limit, which is 85,000, or the deregistration limit, which is 83. Just bear in mind with the 85,000, it's a rolling 12-month test, so you constantly have to be looking at your shoulder, over your shoulder, at what your turnover has been for the past 12 months. The VAT reverse charge on building and construction services was due to be introduced from 1st of October last year. There was quite a lot of other things going on, which, in terms of Brexit and things, which all seems like slightly old news now, even though we're still going through the throes of it. So they postponed it until October 2020 this year. It applies to business transactions in the construction sector, and it will come in this October. It only applies to standard and reduced rate supplies, and invoicing will now be under the reverse charge provisions. So what that means is I'm a subcontractor, and Ian's also in the construction industry and engages with me for me to do some work on a property he's constructing. If I build him today, if I build him £100,000, I'd give him an invoice for £100,000 plus £20,000 VAT. As things stand after October, I'll give him an invoice just for £100,000, and Ian will then have to, in effect, self-assess and charge himself the £20,000 input VAT, which he then puts on his own VAT return and claims as input VAT whilst charging up the line as appropriate. In principle, it's relatively straightforward concept. The concern it's addressing is that someone in government or in the civil service somewhere thought that little contractors at the bottom of the chain might be tempted to charge bigger contractors lots of money for stuff they were doing during the course of the year plus VAT, and then disappear or abscond without having paid over the VAT to HM Revenue and Customs. How big a deal that was, I've got no idea or way of evaluating. Suffice to say, we've had a seminar on it recently and just about got our heads around it. The basic concept is straightforward, but there are quite a lot of wrinkles and fiddly bits in it, where there are exceptions for related parties, etc., etc. So I think because it's such a profound change, someone who's been keeping the books and doing the VAT returns for a construction business for a long time might find it quite a difficult adjustment to make. To that end, we are running a seminar on it later in the year, for which you will likely get an invitation from Maria and her team somewhere down the line, so we can give you a more detailed explanation of it then, if it's relevant to you. Just a couple of other little bits and pieces. Again, because we know we're leaving Europe and we can now act independently of European control on VAT, there's been quite a lobby for the abolition of tampon tax, and that will now happen from the 1st of January next year. so there'll be no more VAT on ladies' sanitary products. Makes sense because it was originally, when that was first introduced, it was in very broad terms intended to be on non-essential items. Well, it seems, obviously with hindsight, it's crazy to describe such products as non-essential to people, so that's going. And similarly, in something which was a bit anomalous and crazy, paper publications, newspapers, books, etc., have always been zero rated, but standard rate continue to apply on digitally supplied books. Now, for example, with my tax legislation, which is an expensive annual publication, when that was all on paper, it was zero rated. I haven't bought it on paper for many years now. It's all delivered to me electronically, but that has been standard rated, which is a nonsense because it's effectively the same product. So that digitally presented tax legislation will be zero rated from the beginning of December this year.
So just finishing off really, as a final sort of big section is employment taxes. Start off with the increase to the national living wage. This is, I think, probably going to hit, again, smaller businesses quite hard, particularly if they've got a large number of lower paid employees. It's actually increasing by 6.2% from April, up from £8.20 to £8.72. This does mean that an average full-time worker would receive just over £1,000 more per annum. I think the bigger picture here is that actually they've said they're going to continue to increase this until 2024, until it will reach actually £10.50 an hour. Now that's quite a significant cost increase to most businesses, and I do wonder where that will leave either the business or whether it will be passed on to the consumer. But just making you aware of those changes. This was really a confirmation of the policy and the strategy for the next 15 years to 2035, where the government then want to ban sales of petrol and diesel cars. They had published benefit in kind rates for company car users back in July last year. What they're saying is that for a fully electric car that doesn't have any emissions, the benefit in kind rate for a company car user will drop from 16% of the list price to 0 from April 2020. So it makes electric cars much more attractive for company vehicles. It's been rolled out really in collaboration with the capital allowance regime, which again has been extended for a further 3 years. It was due to run out at the end of April 21, now been extended to April 24, such that if you invest in a fully electric vehicle or a very low emissions vehicle, you actually get a full deduction for the cost of that vehicle in your tax computation that year. So they really are trying to push the electric car forward. I would just say that there is still scope for hybrids to be very attractive as well, but they really need to have emissions of under 50 grams per kilometre, and then there's a sliding scale based on the electric range that they deliver. But as an example, a hybrid with under 50 grams and an electric range of over just 130 miles actually benefits from a 2% rate. So I appreciate at the moment that is still towards the higher end of the electric car market. You're probably still looking at Teslas, etc. at that, but it's worth bearing in mind. Personal service companies, I think Owen and I are going to tackle together. So this was again confirmation. It's rolling out to the private sector the changes that came in for the public sector back in 2017, so 3 years ago now, scarily. IR35, just a bit of history, it was introduced in 2000, very, very poorly introduced legislation, very poorly enforced, widespread or perceived widespread non-compliance. HMRC have made various challenges over the years, some they've won, some they've lost, but it's been been a very poor piece of legislation. What they're now doing is taking the responsibility as to whether you fall within inside these rules, which would mean you effectively got taxed as an employee, away from the individual doing the work or the personal service company, and putting it on the engaging body. This also shifts the liability, or the potential liability, should you be found to have not done this properly. And so what we are starting to see are some fairly wholesale changes, where larger companies are just blanket covering and saying that everybody's coming on the payroll because they just don't want that risk.
Yes, and as Ian said, this was introduced for public bodies a couple of years back, and it was reasonably successful. It seemed to, as Ian again said, force almost a default position of saying we're going to treat you like an employee. It's been a very problematic raft of legislation. We've had a couple of very high-profile TV presenters who've lost, and equally, I think 3 or 4 TV and radio presenters who've beaten HMRC. So it's all been a bit random historically. So with effect from this April, it's being rolled out to the private sector. So if you're engaging with an individual's personal service company for them to provide services to, and the legislation is applicable to you, you're going to have to take the decision as to whether they look like an employee or not. And then if they do look like an employee, you're going to have to put them through your payroll and deduct tax and national insurance and account for employers' national insurance before you settle their invoices. Having said that, it's only applicable to large and medium-sized businesses. So if you're a small business and you use self-employed, contractors providing their services via personal service companies, you can effectively ignore the changes that are coming in, because the risk will stay with the contractor and their personal service company rather than shifting to your business. I think what we need to do is to think ahead and get some systems in place. So have a system to review your relationship with any contractors that you use if you're caught by the legislation. There are various tools available to do this. The first is the Revenue's got a status checking tool online which you can use. Needless to say, that's stacked in HMRC's revenue favour, because they would like as many as possible to be employees, because it pushes up the NI take that they get. But I think, Ian, you said you'd seen...
Yeah, there's a few places now that will offer... They've been through the legislation, they've built tools which they believe offer a fair review as to whether somebody does or doesn't fall within IR35. And actually I was quite surprised, because I'd almost discounted it, but having had a look at them, they are insured by some big insurers, so they're underwritten that if HMRC investigate and are found to disagree with the decision that's been made, the tax liability is actually covered. So it is worth, particularly if you're a larger business and you're engaging with a lot of these people and you can't afford to lose them, which putting them on the payroll and having higher tax would force, it is worth looking at these alternative measures, because you might be able to get a different decision that you can stand by.
And I think the other thing, just to check, if you are an employer, i.e. you're contracting with a personal service company for them to provide you with services, if you think you are going to have to put payments through your payroll, it's quite important to understand before we get to the first payday after April that you have got a grip on how your payroll software will deal with this. So that brings us on to EMI schemes. The government appear keen on the scheme as a useful tool for companies to be able to incentivise their workforce without just throwing cash at it. So if you're starting up a business with a view to building the business and then selling it on, a good you're obviously going to want to maintain what cash you're generating to plough back into the business to grow it. But if you've got some very key employees, what are your alternatives to just giving them a very high salary? Well, what you can do with the EMI scheme is you can issue them shares, issue them an option to acquire shares at a current value. So let's say we managed to argue with HMRC that the current value on a par £1 share is only £1.25. You can give those individuals options to buy shares at £1.25. They can be completely dependent on conditions being satisfied. So you could set the condition to be satisfied that we successfully negotiate for the sale of the company. Then if 8 or 9 years down the line you successfully sell the company for £10.25, normally that £9 increase in value to the employee would be taxed to income tax at up to 45%. But because you've got it within a qualifying share option scheme, that's taxed to capital gains tax, and again potentially that will be subject to entrepreneurs relief, because an EMI option is the one scenario where you can accrue an entitlement to entrepreneurs relief on a share option rather than the actual shares. So it works both for the employees concerned and also for the employer in terms of motivating their key employees. As I say, the government seem to like these and think they work well, so they're doing a review. There's quite tight parameters on who can currently use an EMI scheme, so they're launching a review to see if this could be of broader application out in the marketplace.
Perfect. So just finishing off then, these were the other bits and pieces that we found. Non-resident stamp duty, this is a move that's not coming in this April but actually next April, so April 21. It's an additional 2% surcharge for any non-residents who are buying UK property. I think it's part of a push by the government to try and stop non-residents buying UK property and leaving it vacant, given the current housing need across the country. And this is actually in addition to the 3% surcharge, which is already in place if somebody has an existing interest in a property when buying another one here. So the maximum stamp duty rate on a higher value property would potentially be 17%, which is now getting actually quite significant. That's enough to put somebody off, I think. So that's just one to watch for. The business rates relief, we couldn't really not talk about this. It was the headline. So small businesses with a rateable value of under £51,000 will have been used to, for the last year, being able to claim small business rates relief, which is a 50% deduction. The Chancellor's actually increased that to be a 100% deduction, so they've got a rates-free year. I think this is a huge benefit to the small independent businesses and will hopefully help some survive over the next few weeks, months and year, with the difficult trading conditions that the High Street has already seen and that the recent coronavirus outbreak has only really added to, plus the floods that parts of the country saw a few weeks ago. They have said it applies to approximately 900,000 properties, so I think there should be a widespread use and uptake on this, and hopefully a useful benefit. I would just also add that there was a relief for pubs along a similar line. So if a pub has a rateable value of less than £100,000, they will get a £5,000 discount on their rates, up from the £1,000 that was promised last year. So again, it's really a drive. The government see pubs as the sort of hub of the community, and they're trying to see a decline in the decrease of those. The final thing is, it's just linking back in with exactly what Jonathan said to start us off, really. Regardless of how successful or how good your business has been over the last however many years, you can find yourself in some difficulty and it can creep up on you quite quickly. HMRC have confirmed that they have redeployed 2,000 experienced call handlers onto a separate coronavirus type line, which is called time to pay. It's a two-phase approach where you've got outstanding liabilities owed to HMRC. The first step is that they'll actually give you a deferral period to relinquish that initial burden that falls on the shoulders where you think, I'm not sure what I'm going to do. And then once that's up, they'll agree a repayment period with you that's affordable and over a number of months. Now, there will be interest charges, but HMRC are accepting of this, and they're not daft. They know that their best chance of recovering this money is to help you. They don't want to see businesses fail. So I think, as Jonathan was saying, don't bury your head, don't ignore the envelopes that land on the doorstep. If you need help, talk to us or talk to HMRC, and they will do their best to help.
Right, quick rattle through fuel and alcohol duties. Alcohol duties on wine, beers, spirits remain unchanged. Obviously good news for pubs and also Scottish exporters of whisky who've been hit with the US tariffs since the back end of last year. They're also getting £10 million towards researching green and more energy efficient production means. Fuel duties are frozen with one exception, the exception being red diesel. As you may be aware, red diesel, various groups are allowed to use red diesel, which has a lower rate. Just to give you an idea of the difference, the duty on red diesel is 11.4%, whilst on white diesel it's 57.95%. I've got particular interest in one of these because the groups who can use red diesel are currently construction industry, a couple of other niche industries, farming and pleasure craft are allowed to use red diesel. I'm living on a narrowboat at the moment, and we've got a wonderful self-assessment system where you go in and you have to assess how much of your red diesel is going to be used to heat the boat and how much of it is for propulsion, because you have to pay the full rate on the propulsion bit, but you can get the reduced 11.4% rate on the heating bit. If you ever see a narrowboat going down the canal, probably worth taking a picture of, because it'd be a very rare beast, because the number of people I've queued up behind where 95% of their fuel is for heating the boat and 5% is for moving it, I don't think the blooming things ever move. So, they are scrapping the availability of the reduced rate on red diesel, and everyone's going to have to use white diesel from 2022, with the exception of farmers who are being exempted, presumably on the basis that they're going to have hard enough time with subsidies going and they're already up against it. Anyway, so the biggest impact, apart from my heating bill on the boat, is likely to be for the construction industry who aren't exempted. So they're going to have roughly an extra 46% duty to pay on the diesel that they're using.
I would just say there's a fairly limited use, but having read through the legislation, whilst the construction industry is hit, as Owen said, they have specifically excluded any construction industry that's involved in rail construction and building the railways, presumably to try and help HS2 on its way. But I wonder if we'll see more people starting to try and build railways.
And then just to conclude from me, the only other announcements he made, which again might help the construction industry offset slightly the big increase in the duty they're paying on diesel. There's going to be huge investment in the Stonehenge bypass. I believe they've approved is it a tunnel underneath now?
I think that's the way they're going.
And road and rail links nationwide. They're going to get a big injection of cash, and broadband infrastructure. Like all of these projects, the way we seem to deliver big projects in this country compared to some of the other countries around, would probably be my grandchildren who see those arrive rather than myself.
So then the final piece was there is funding to repair 50 million potholes. I did steal one of Owen's summer holiday snaps, and yeah, I mean, I think we're all fed up with the state of the roads, and so that's a welcome relief. Just be interested to see, as Owen says, how quickly they get on with it.
So I think that's it. So any questions, either ask us now, or if you've got a question you'd like to ask us with a little bit more privacy or whatever, come and grab us before we depart for the next episode of this.
Indeed.
Thanks very much for
Thank
coming.
you.
See you next time.